Welcome to the InterMarket Analysis update. This is a video that I do once a week where I look at not only the S&P 500, but I look outside of the S&P. We look at other sectors, we look at other markets, because no market exists in a vacuum. And sometimes we can get some clues as to what's ultimately happening with the S&P 500 by studying some of these other markets and to see how they interact with each other. And these change over a period of time. There are times when one market may have a big impact on another market, and then other times where it's kind of irrelevant. And so these relationships come and go, and that's why we look at this on a weekly basis. This is being prepared for Tuesday, February 20th. The first thing that we look at is S&P 500 valuation. And we use a thing called the PE ratio, the price to earnings ratio. Now, when this was first developed, it was set up so that it works on a static scale. 10 or below is considered inexpensive. 15 is considered to be fairly priced. When we get at 20 or above, then it's considered to be expensive. And so we can look at this not only by historical earnings reports that have come out to see what the market was valued in relation to what was really reported. We can also look at this on a forward basis to see, okay, based on analyst projections and forecasts, is the market considered to be expensive, fairly priced, or inexpensive at any given time? The first area, this looks back at the TTM, or trailing 12 months. And what this chart is, we have the 10, 15, and 20 PE ratios here represented by the different colored dashed lines. And we're above the red dashed line. So we're above 20 when we look at the historical prices. The black line is the S&P 500 itself. And as I said, we're above that. Down below, when we're above that red dashed line, that's when we get a positive result for this particular chart, and we are considered to be expensive. Now, we don't necessarily use this to make decisions. You can see here in the chart, we can go years and be either overvalued, undervalued, what have you. And so this isn't a really good timing mechanism. However, it is good just to give us some historical perspective. Also, a service or a website called Real Investment Advice, they have a chart that's very similar to this. I've been showing this the last few weeks. The black line on top is the S&P, and then we have the red, blue, and green areas to show you that we're also considered to be expensive on a historical basis. This also looks at different major market events that have happened and what the valuations were during that time. Also, we look at a little different variation of that. This was developed by Robert Shiller, where we take an average over a period of time. You may also hear this referred to as CAPE, C-A-P-E. And what he does is he calculates this using earnings reports over a 10-year period, and then he comes up with a valuation, and right now it's coming in at 33.69. Well, to give you some perspective, we can look at the historical chart to see what prices were and what the levels were at any given time. And right now we're above where we were back before the 1929 crash. We're above where we were back before the 1987 crash. We're below where we were when we started to go into the dot-com boom and then ultimate bust. But also to give us a little bit more perspective, we can look at the median and the mean for this over a period of time. And this is just under 16 and just over 17 when we take these numbers together. So we're kind of twice the value of what we should be as far as the ratio is showing us here. But again, this has gone on for quite a while, so it doesn't necessarily mean the market's going to fall apart at any time soon. But the market looks forward, and that's really what they pay more attention to. What you see on this chart, this is put out by Edward Yardeni, who's a very well-respected economist, and based on analyst projections and forecasts going forward, we have the red line here, which is the S&P 500, and as of Friday's close, the forward-looking PE comes in at 20.3. So we're a little bit above that 20 level. If we look at the S&P 400, which is the blue line, that's the mid caps, and it's coming in at 15.4. So it's right around being fairly priced. And if we look at this green line, that's the S&P 600. Those are the small caps, and it's coming in at 14.8. So a little bit under that fairly priced level. And so we can follow this, and this will change all the time. In fact, this is updated daily. as the S&P goes up or down, and then as forecasts are adjusted. Then there's another thing put out by Real Investment Advice, just showing earning estimates, and they recommend here, according to what we see, is that the estimates are well ahead of realities, where these are the projections going forward. And so in order to be able to justify that, the S&P would have to go up, but we'll have to see as these earnings estimates are adjusted, and if they're adjusted down, then that may end up putting some pressure on the S&P. Then we also look at the consensus earnings per share. And you think about this, it makes sense. The analysts, when they're projecting out a year, 2 years, 3 years into the future, they're going to come up with any kind of number that seems at least somewhat logical, but it's probably going to be pretty high. And then as that particular quarter, as that number gets closer and closer to the time of actual reporting time, then they start to fine tune it and adjust it. And most of the time they adjust it down. And we can see that. That's the yellow line of the historical average, how things are adjusted as we get closer to that particular earnings date. Then with the dark blue line, this is how they were adjusted back in 2023. And this lighter blue line, this is how they've been adjusted so far into 2024. So it's not necessarily common to see this coming down because these analysts want to be optimistic. They want to have good earnings reports. They want their phone calls and emails returned when they call the companies to try to get information from them. And if they're bashing the company, they're probably not going to get much cooperation. Or if they're coming out with rosy outlooks, then they're probably going to be treated better. Another area that we look at is growth versus value. Growth is the idea that you want to buy low and sell high. Value are the things that folks get into when we're chopping sideways or even declining in the market, since those are areas that tend to hold up better. They may go down, but they may not go down as much as growth. For example, in 2022, it was really growth that led things lower. These are the stocks that are now doing really well, the big mega cap stocks. Those are growth stocks. And so we want to compare one area of the market to the other area of the market to see which one is performing better. First, we look at just a pure growth index. And based on this, we are in an uptrend. So growth is in an uptrend now. And value is also in an uptrend now because the whole stock market has been doing quite well since the October 2022 lows. When we get some insight is when we do a ratio between them. And on top, we have a growth to value ratio, and that shows that growth is outperforming. And then down below, we have a value to growth ratio showing how value is underperforming. And I get asked this a lot. Why do you have different charts? Why do you flip them upside down? Well, first of all, we may get some different perspectives by looking at the same thing upside down. And also, you notice that when we saw this moving average crossover here, it was offset a little bit. And when you're getting ready to make some decisions, you want to see a lot of things confirming that what you're actually seeing in the charts is playing out that way. And so this is just more to provide some confirmation. Then we look at growth to value with a number of different ways. This is a longer term chart showing a growth to value ETF, showing that growth is outperforming. We did see some weakness going into the latter part of 2023, but now it's been bouncing back up. Here's an inverse of that same chart showing how value was really bouncing up and now starting to pull back. Here's another longer term look at the growth to value indexes that we looked at before. It's still in a longer term downtrend, but it's starting to turn up, and we could be getting ready to see a golden cross here as growth is outperforming value. This is a little shorter term look here showing how value is underperforming growth, or you could also say growth is outperforming value. And then here is another measurement just showing how growth is outperforming. So we're getting this with the different views, different indexes, different ETFs, just to kind of confirm that we're seeing the same things. Then we take another look at this in a slightly different way. We use a rainbow chart where we compare growth to value with some different ETFs. And even though we pulled back over the last week, this is still showing how growth is outperforming, but we haven't got back to the high that was set back in late 2021. Here's an inverse of that same chart showing how value has been underperforming, even though it bounced up in the last week. Now we look at small caps, and this has been a real area of frustration, but lately we're starting to see a breakout here as small cap growth has been outperforming small cap value. It did bounce back later in the week and drop down a little bit, but we've been chopping sideways for about the last year, and now we're seeing some of an improvement here, but we're not really seeing that yet with the index. Now, we've been seeing a little bit more of a sustained upward move when we look at mid-cap growth versus value. It's also breaking out and now starting to pull back a bit. And this index is looking a little more promising, but it's not back to setting an all-time high, at least yet. Then this is the one that I pay attention to the most. This is S&P 500 growth to value. And this had really been underperforming as we were going up out of the October lows. That was producing a negative divergence. And you notice as this was happening, we started to chop sideways. We came back a little bit. We weren't really breaking out to the upside. Then when we saw this ratio start to go back up, that's when we saw the S&P turn and really start to get some real power as it was moving higher. Now, it has pulled back over the last couple of days, but it has been showing some improvement since the beginning of 2024. We also keep an eye on inflation, where on top we have a monthly chart, the CRB index. This has pretty much been chopping sideways, and we're right about on the moving average. Down below is a ratio between inflationary areas and deflationary areas, and this is continuing to drop off, showing that inflation is actually going down. We look at the CRB index in and of itself. This is a daily chart showing that it continues to be in a downtrend. We look at the Baltic Dry Index, which really spiked up and is coming back down. It's still in a longer-term uptrend, but it has been coming down lately. And then some other markets. We don't trade these markets. I just like to keep kind of a watch on these markets just to see if anything really strange is happening. This is aluminum, and this shows that aluminum continues to be in a downtrend. We're also showing corn in a downtrend. Wheat, it bounced up, but it's still in a downtrend. Here's fertilizer, which is starting to bounce back up, but it has been in a longer-term downtrend. Oil's been chopping around. This is very influential to us. We're still in the mid-70s to even upper 70s now. And this shows for the month of February, oil prices and recessions. These are just different events that have happened going back into the 70s. Of course, you had the Yom Kippur War. Then in 79, 78 into 79, you had the Iranian Revolution, and then how prices really went up after that. Well, in more recent times, we saw oil really spark up when the Russia-Ukraine war kicked off, and then we started to fall back. And this other little spike is when things really started to escalate in Israel. We are keeping an eye on gas. It's still in a longer-term downtrend, but it has been shooting back up over the last few trading sessions. Diesel also has been turning back up, even though it's still in a longer-term downtrend. Heating oil starting to go back up, but still in a downtrend. Natural gas has really been actually going lower here and is hitting really very low prices right now. Copper has been more or less chopping sideways as the economy is trying to figure out. Usually we'll see copper going up if the projection going forward for the economy is positive. If we see economic weakness going forward, copper then may be under some pressure. The fact that this is chopping sideways just kind of shows that they're not really sure what's going to happen economically right now. Then we look at a copper to gold ratio. When this is going up, that means copper's outperforming gold. We had been seeing this ratio going down, but just lately, as gold's been under some pressure, copper has been outperforming. This is a longer-term look at that same chart. That's the black line going back to 1980. This is the copper to gold ratio. And just to give us some perspective, we have the 2-year yield in green and the 10-year yield in red. Notice that the green is above the red. That's because we're inverted still. And they are still quite far apart from each other. Where if we drop back a few years, you'll notice that they have a tendency to move in the same general direction, and they have a tendency to not get that far apart from each other, even though they're on different scales. We've seen a wide spread here that's gone on now for a few years, and sometimes they've actually been going in opposite directions as the economy is trying to figure out where it's going to go from here. Here's gold, which just about the time it looks to be breaking out, that's when it ends up pulling back, even though we're still in a longer-term uptrend. Sorry about clearing my voice here. When we look at silver, we are still in a downtrend, even though it's been bouncing back up to its moving averages. And then on the top, we have the end-of-day value for gold and the end-of-day value for silver. And we look at the correlation between the two. Now, logic would just dictate that, okay, if gold's up, silver should be up and vice versa. Right now, they're pretty much neutral, where we're seeing silver going up more than we are seeing gold right now, and that's why we're seeing the correlation fall off. Then on top, we have the gold to silver ratio, which has been going down. And then sometimes we can plot the US dollar index in here, but right now, sometimes when this is a highly correlated relationship, we can get some insight as to what may be happening with the dollar. But for right now, since we're getting more of a neutral reading, this chart really isn't helping us. Here's the dollar, which since the beginning of 2024 has been rebounding. We're still in a downtrend here, but if we can stay above these two lines, we may eventually generate a golden cross. Here's the euro, which has been declining when we compare it to the dollar. And on top, this is the Japanese yen, which is in a downtrend compared to the dollar. And here's the euro, where we're dropping below the moving averages, even though the euro is still in a longer-term uptrend. The Japanese yen continues to be in a downtrend compared to the dollar. The British pound's been pulling back, but it's still in an uptrend compared to the dollar. And then looking at some different indexes, and I show this in the daily videos, where the equal weight index over the last few trading sessions has actually been outperforming the S&P. And it had been underperforming there for quite a while, but it's showing some improvement. And because the S&P 500 is a weighted index, so when the mega caps do really well, that tends to outperform. When we see more broad participation across more stocks in the S&P 500, that's when the red line tends to outperform. And then this is a ratio between the equal weight index and the S&P 500. When this is going down, that means the mega caps are outperforming. This did tick back up over the last trading session or so as the broad market was outperforming. Then we look at a ratio between the S&P 500 and the CRB index. This shows that stocks are outperforming commodities. This shows that commodities are underperforming stocks. The NASDAQ 100 continues to outperform the S&P 500. Now, they're both right near all-time highs. They're both doing really well, but this has been showing over the longer term that the NASDAQ 100 has been doing even better. The S&P 100 continues to outperform the S&P 500, and the NASDAQ is also outperforming the S&P 500, which the NASDAQ's not back to an all-time high where the S&P is. We look at the NASDAQ 100, which is setting all-time highs in the NASDAQ, showing how it's rolling over a little bit here, but it's still been outperforming. We want to keep an eye on this as we're seeing a little bit of rolling over when we look at the mega caps. And then we look at the mega caps here and compare it to the equal weight. This is just showing how the mega caps have been outperforming, but over the last few sessions, it's been declining. And then we look at a ratio between small caps and the S&P 500. That's the red line. Right near the end of 2023, this is really going up as we were supposedly seeing the January effect. Then we hit 2024 and boom, we've been going down. Over the last week or so, we've been seeing an improvement with this ratio, but we want to see this continue to go up to have some sustainability there. The small caps, the S&P 500 ratio shows how the small caps have been underperforming. This was the up move into the latter part of 2023 and then the downward move. We are seeing some improvement here. And here's the biggest software companies, which are starting to go in a more solid uptrend. The mega caps, they're also in a solid uptrend as well. And the robotics and AI ETF is also showing an uptrend here. It hasn't quite broken out above this previous high yet. And even though it's doing well, it's been underperforming when we compare it to the tech sector. It's showing some improvement here, but it was really underperforming earlier in 2023. Here's the Dow Jones Composite Average, which is the Dow, the transports, and utilities all put together. And most of this is coming from the Dow, as the Dow is achieving new all-time highs. The transports are not looking all that strong, and the utilities are actually in a downtrend. So this upward move is mainly from the Dow. Then we look at the S&P 500 and compare it with shorter-term bonds. This is showing how stocks are outperforming. Then we look at a thing called the S&P 1500, which is another broad market measure. Compare it with shorter-term bonds, showing how stocks are outperforming. Then we look at a broad market measure, and then we look at further out bonds. This is also showing how stocks are outperforming here. This is a low volatility ETF, which held up a lot better in 2022 when we were chopping around. And again, it went down, but it didn't go down as much as some of the growth stocks. This has actually been bouncing back up and we're seeing more of an uptrend here. But when we compare it to the S&P 500, it is really underperforming and in a solid downtrend when we look at this ratio. We look at the tech sector, which continues to outperform the 3 to 7 year bond ETF. And then we look at some other stocks. And I show this in every daily video. This is the advanced decline line for the NYSE Just Common stock, where it's still above its moving average. The S&P, it declined a bit on Friday, but it's also above its moving average. We're still above the moving average with the mid caps, and we've been showing some improvement with the small caps, but it's still lagging behind here. And then this is traditional Dow theory, where we're really close to an all-time high with the Dow. We're not even back to this previous high with the transports, and the utilities have been under a lot of pressure lately. This is a longer-term look at the transports, where we're actually declining right now. We did get back to this previous high set in late 2023, but now we've been pulling back. And then we need to get back to this previous high set back in the summer of 2023. That would be more positive, but we're going in the opposite direction. And then the all-time high was set right near the end of 2021, and we're not even close to that right now. We want to see this going up and setting an all-time high to confirm the all-time high that we're seeing in the Dow. Until we see that, that is called a negative divergence. And we're also looking at a ratio between the transports and S&P. When this is going down, that means the transports are underperforming, and you can clearly see that this is continuing to go down. Then we look at a ratio between the Dow and the transports. When this is going up, that means the Dow is outperforming. We want to see the transports doing better than what they've been doing here. And then we look at the correlation between the S&P and the transports. They were getting to kind of a strong relationship, but then over the last few days, this has dropped down to more of a neutral reading as they're going more or less in opposite directions, or they're not really connected to each other right now. And then this is a new take on Dow theory promoted by David Keller from stockcharts.com, where instead of using the Dow, we use the S&P 500. And instead of using the transports, we use the NASDAQ because that's technology. And we're mainly looking for some kind of divergences here. And we're not really seeing that other than the long-term one, where we're setting all-time highs with the S&P, and we've not set an all-time high with the NASDAQ. Now, we're not all that far away, but it would turn things back more positive if we went back and set a new all-time high with the NASDAQ. And we look at the FANG index, which has been setting a series of all-time highs lately, even though it declined over 1% on Friday. And if we do really start to fall with the FANG index, we're going to be looking at these other areas here for potential support. ARK, which is a very popular investment, continues to be in an uptrend. And then we look at a monthly chart of the S&P 500, and with a ratio of stocks in Europe, Australia, Asia, and the Far East. When we're above this red line, that means the S&P is outperforming and we're continuing to go up. We can also look at the percentage price oscillator, or PPO, and this is also continuing to go up. This just means that US stocks, or the S&P 500, is outperforming global stocks. And we keep an eye on bonds, where we've been pulling back a bit lately based on price, but we're still in a longer-term uptrend. The World Bond Index also pulling back, but still in an uptrend. Stocks continue to outperform bonds. When we look at a monthly chart, this is a daily chart showing how bonds are underperforming stocks. So we have a longer-term chart and a shorter-term chart, which are confirming each other. These are high-yield corporate bonds, which we often call them junk bonds. They're in a solid uptrend, but they haven't set a new all-time high, at least yet. Investment-grade bonds are also in an uptrend, but they've been pulling back recently. And we look at riskier bonds and compare them with more conservative bonds. When this is going up, folks are preferring more the riskier bonds because they give a higher yield. They're willing to take on that risk. Here's a stock-to-bond correlation where we're pretty much neutral right now. We're not getting anything really useful from this chart. This is the Dow Jones Corporate Bond Index, longer-term uptrend, but lately it's been pulling back. Here's the 10-year yield, and I redrew the Fibonacci retracements. I went up to the 5% level that we hit last October, and if we come down, we'll be watching the 61.8% retracement level. And then this is a longer-term chart of the 10-year yield, where going back to 1980, where we saw a series of lower highs and lower lows. Now we could be shifting to an environment where we see higher, longer-term interest rates. And this is a chart I've been showing for a while. Back in October, we set a really low reading with this ratio. And this is when the market was finally starting to think that we were going to have a soft landing, meaning if the economy was showing a slowdown without going into a recession. and that the Fed was going to start cutting interest rates. Okay. And this produced a really low reading with this ratio. The only problem with that is we have another couple of readings here, but this is after negative things happened. This was the Euro crisis back in 2011, and this was after the COVID plunge in 2020. And this is a positive thing. So it's like, okay, we have two negatives and a positive. We're wondering, can we even trust this? But for right now, we want to be aware of this. Now, the situation has been changing. It looked like interest rates were starting to go back down, but now they're starting to go back up. So this chart may not be relevant for much longer. Here's the 30-year yield showing with the different Fibonacci retracement levels. And then we're showing a ratio between the S&P 500 and the 10-year yield, showing how stocks are outperforming, but we have been chopping sideways lately. This looks at bonds and compares them with the S&P 500. When this is going down, that means stocks are outperforming. You could also say that bonds are underperforming. Here's the junk bond ETF, which continues to be in a solid uptrend and not quite back to setting a new all-time high. Here's a ratio between junk bonds and more conservative bonds, showing how the junk bonds are outperforming. And then we're looking at a bond ETF where we're still under some pressure here. We've been coming down with price, even though we're still in a longer-term uptrend. But the RSI is below 50 and declining, and momentum has been negative since the beginning of February. And we're coming back down to the 200-day moving average. This is a daily chart of the yields going across the different maturities, where we hit this top back in October, and now we've been coming down. We've been chopping more or less sideways, and now we're wondering, are interest rates starting to go back up? This is a weekly chart looking internationally with the US, UK, and German rates going up, as well as the Japanese rates. And then we have the MOVE index on top, which measures the volatility of bonds. The VIX measures the volatility of stocks, and they're having a pretty strong correlated relationship right now. So if bonds are going up, maybe stocks are going up as well, or they both could be going down at the same time. Then this is a monthly chart of the longer-term bond ETF, which still continues to be in a downward trend when we look at it based on price. When we do a ratio between the price of the long-term bond and the CRB index, it shows the bonds continue to outperform. Here are different sectors, and we take each sector and compare it to the S&P 500. Here we have the materials to S&P, which is in a downtrend, even though it has bounced back over the last few days. Communication has been one of the stronger areas in the S&P, even though it's been pulling back. Energy has been underperforming the S&P 500. The financials are still in an uptrend here. We did get that New York Community Bank news week before last, and we're wondering, is more news going to break after this? But for right now, the financials are holding up. Here's the industrials, which continue to be in a longer-term downtrend compared to the S&P. Tech sector, one of the stronger areas, even though it's been pulling back. Staples are underperforming the S&P. Real estate is also underperforming the S&P. When it looked like we were bottoming here and coming up, that's when interest rates look to be topping and we're starting to come down. Well, now that interest rates are going back up again, we're seeing this ratio going down. Utilities are also underperforming the S&P, and we look at an S&P to utilities ratio. When this is going up, that tends to mean the S&P is outperforming, and usually that means the S&P is going up. When this is going down, that typically means the S&P is going down at the same time. We look at the healthcare sector, which is underperforming the S&P, even though it did bounce back up over the last few trading sessions, and healthcare is also underperforming. Discretionary, we want to see this doing better than it has been, and it has bounced over the last few sessions, but it's still in a longer-term downtrend. The staples sector, which you'd think would be doing weaker if the economy was actually improving, since we bottomed here back in September, October, it's been really in a solid uptrend, and we're seeing a recent golden cross here. But lately, over the past few sessions, since the beginning of February, it has been pulling back. The tech sector continues to be one of the stronger areas in the market. Semiconductors also really close to setting all-time highs. The tech sector is really outperforming the S&P, even though it has been pulling back over the last few sessions. The energy sector is underperforming the tech sector, and growth continues to outperform the more conservative bonds. And here's another look at tech compared to the rise in interest rates, showing that the tech sector is outperforming. Here's an inverse showing how interest rates are underperforming the tech sector. Discretionary to staples shows that discretionary is outperforming. This also shows where staples has been underperforming. And then gold has been underperforming the S&P. And gold has also been underperforming the dollar as the dollar's been rebounding. These are high leverage loans, very risky loans, which are pretty much setting all-time highs, it seems like every other day now. And the NYSE composite, really close to setting an all-time high and in an uptrend. This is what we use to measure the broad market. All stocks continue to be in an uptrend and setting all-time highs. Emerging markets chopping more or less sideways, but they are also in an uptrend. And this is taking a ratio. I've been showing this chart for the last few videos here. Emerging markets, when you compare them to US stocks, and it shows that the ratio is really going down. And sometimes this is when folks like to start jumping into the emerging market stocks. And then this looks at some different countries. We have Mexico, India, Turkey, Indonesia, Brazil. The red line in here is the S&P. This is a little bit outdated because I've been showing this graphic here for the last few videos. And then this, and I have a chart right after to show you the update on this. The Bank of America came out and they said that they were bullish on Japanese stocks. They thought they were going to go back and surpass the high set back in 1989. Well, here's where we're at. This is the Nikkei. That's their main index. And we're getting kind of close here. This red line would be the high that we set back in 1989. So they may be right in that call, but we haven't quite done it yet. We look at the micro caps, which are very small companies. We continue to be in an uptrend there. And the home builders, we look at this for any kind of divergences. We're not really seeing any right now, so we're not getting much insight here. Bitcoin continues to be in an uptrend. It actually went up above 50,000. It's still above that, even though it pulled back slightly. And then we look internationally, where China's in an uptrend, emerging markets are in an uptrend, Europe is in a downtrend. We're trying to bounce up a little bit in Japan, and we're also in an uptrend now in the US. And this is InterMarket Analysis going back to the beginning of 2024, where we have oil in the lead, followed by stocks, the dollar, gold, and bonds. Then we look at some correlations between the S&P 500 and the dollar. We're just coming out of getting a neutral reading here, so we're not getting a lot of insight from that. We're seeing where the S&P 500 and the oil are having somewhat of a tendency to go in the same general direction. We're also coming back into a neutral reading with the S&P compared to the 10-year yield. Also neutral when we look at the tech sector compared to the 10-year yield. And also coming into a neutral reading with the S&P to the 2-year yield. And then some long-term measurements. This is a monthly chart of the NYSE, and we're above this red line, so that means we're in an uptrend. The Copic curve, which is a momentum oscillator, also continues to be positive. And then we look at a daily chart of the NYSE, and we look at a thing called the NYSE Record High Percent Index. That continues to go up, so that's shorter-term positive. So we look at the previous chart, that's long-term positive, and it's being confirmed by a shorter-term positive chart as well. Then we look at the S&P, it also continues to be above this longer-term moving average, and the PPO continues to go higher. So that's a monthly chart, so that's long-term positive. Then we look at the S&P on top. This is a daily chart, and we're above the moving average. And then we look at a ratio between the S&P and commodities, showing that stocks are still outperforming. Then we look at a monthly chart of the S&P and another global index, showing how the S&P is outperforming. And we're just starting to cross over here with the KST. This is a long-term oscillator, and it takes a long time for this to actually develop and show a change. All right, then at the end of this, I have a whole list of the things that are positive and those things that are negative. My definition of positive as it applies to this video is when the 50-period simple moving average is above the 200-period simple moving average. And if you watched the video a week ago, there hasn't been a change. We have the growth indexes and the value indexes. Copper is chopping around, but it's still in an uptrend. The British pound and the euro compared to the dollar, even though they've been pulling back. Gold, even though it's been pulling back, it's still in an uptrend. The biggest software companies, the mega caps, the FANG index, ARK, the low volatility ETF, staples, the Dow Jones Composite Average, which is mainly the Dow that's giving all the strength there. and all the different bonds that we look at based on price. Even though they've been pulling back, they're still in longer term uptrends, such as the high yield or junk bonds, investment grade bonds, corporate bonds, the other junk bonds that we look at, and world bonds. The tech sector and semiconductors are still in uptrends, high leverage loans, the Dow, the NYSE composite, the NASDAQ and NASDAQ 100, mid caps, small caps, and micro caps, all stocks, emerging markets, and then way at the bottom is Bitcoin. And then my definition of negative as it applies to this video is when the 50 period moving average is below the 200 period moving average. The dollar is improving, but it's still in a downtrend. The CRB index is in a downtrend, silver's in a downtrend, and the Japanese yen compared to the dollar is in a downtrend. So thank you. I hope you found this helpful. Please feel free to check out the daily videos. And I also posted a weekly video. After this, I'm going to be preparing what I call a deep dive video, where I go through all the different charts that I really didn't talk about in any of the videos, and I present them in that particular video. So have a great weekend, and I will talk to you in the next video.